Hello financial fans, welcome back to another stock analysis. Today we'll be covering 3M Company stock ticker MMM. 3M Company, also known as the Minnesota Mining and Manufacturing Company, is a multinational conglomerate corporation based in the United States. The company operates in several industries including healthcare, consumer goods, transportation, electronics, and energy. 3M is a well-known brand for its innovative products and technologies, and its diverse product portfolio includes items such as adhesives, abrasives, filtration systems, and medical devices. Some of the company's most recognizable products include post-it notes, scotch tape, and NextCare first aid products. The company's healthcare division offers a range of products such as dental and orthodontic supplies, infection prevention products, and medical tapes and dressings. 3M's customer division offers products for home improvement, cleaning and organizing, and personal safety including respirators and protective eyewear. 3M is also involved in the transportation industry, offering products such as window films, paint protection films, and adhesives in vehicle assembly. Additionally, the company provides solutions for the electronics industry, including components for circuit boards and touchscreens. 3M has a reputation for its commitment to sustainability and social responsibility, and the company has established ambitious goals for reducing its environmental impact and promoting ethical business practices. In recent years, 3M has faced several lawsuits related to certain products and activities. One significant lawsuit was related to the company's manufacture and sale of earplugs used by the US military. In 2018, 3M agreed to pay $9.1 million to resolve the allegations that it knowingly sold defective earplugs to the military, which caused hearing loss and tinnitus in some service members. 3M had also faced lawsuits related to environmental contamination. In 2019, the company agreed to pay $55 million to settle a lawsuit alleging that it contaminated drinking water with PFAS chemicals in Minnesota. Additionally, 3M has faced several lawsuits related to asbestos exposure and has paid out millions of dollars in settlements to individuals who have claimed to have developed cancer as a result of the company's products. The company is currently sitting at a market cap of $61.3 billion, and the revenue in 2022 was $34.2 billion, and the dividend yield is sitting at 5.46%, and they're a dividend king. 14% of their revenue comes from consumer business, 24% from healthcare, 35% from safety and industrial equipment, and 27% from transportation and electronics. To determine the final valuation of the stock, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company. I will be using a standard margin of safety of 25%. That can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety can increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. The first two metrics that we'll be using is the EBIT growth and the margin growth. The EBIT has gone down over the years, going from $6.6 billion in 2013 to $5.6 billion in 2022. The average EBIT decline was 1%, which is a 5% increase in the margin of safety. This with a margin that has also gone down, going from 21.6% in 2013 to 16.34% in 2022. The average decline was 2.4%, meaning another 5% increase in the margin of safety. The next two ratios are the dividend growth and the payout ratio. The dividends have gone up over the years. As they are a dividend king, they have increased the dividend significantly, going from $2.36 a share in 2012 to $5.96 a share in 2022. The average increase in dividends year over year was 7.4% annually on average, which is a 5% decrease in the margin of safety. This was a payout ratio of 58.8%, meaning no change in the margin of safety on this metric. The final two ratios that we'll be using are the debt to EBITDA and return on invested capital. To get our debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For 3M, this is almost 2 years, in this case a 175% debt to EBITDA ratio, meaning no change in the margin of safety. The return on invested capital is sitting at 10.5%, meaning no change in the margin of safety once again. Looking not the best so far for 3M. But let's see what the valuation models will bring to determine the intrinsic value of 3M. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow of 3M going from 2013 to 2022. The average growth in free cash flow annually during this period was 0.77%, and I'm projecting an expected growth rate of 2% annually in their free cash flow over the next 10 years. This because their free cash flow has gone down a lot over the past year, and I'd love to see it increase just a little bit again. With this percentage, we determine the future free cash flow for 3M and determine a terminal year valuation, using a perpetual growth rate of 3% and a discount rate of 8.5%. With this, we get a sum of free cash flow of $67 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $54.1 billion. All it's left to do then is to divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $98.28, which is an 11.67% downside from the current price. The second model that we'll be using is the dividend discount model. I've imported the dividend payouts of 3M going from 4 years ago to the current year. The average growth rate in dividends during this period was 2.33% annually. And I'm projecting an expected growth rate in dividends for the future payouts of 3%, and will once again be using a discount rate of 8.5% in this valuation, giving us a dividend discount model price per share of $111.61, which is a small 0.32% upside of this model. The third model that we use is Graham's revised valuation formula. In this model, we'll be looking at the earnings per share that 3M is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield it has been over the past years. We'll also go by the theory that the PE of a company with no growth is always at 7, and looking at all of these metrics, we get a fair value of $66.61, which is a 40.13% downside of this model. The fourth model that we'll be using is the multiple valuation. In this model, we look at similar companies to 3M, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is 24.34. All it's left to do to get a fair value then is to multiply by the earnings per share that 3M is generating, which is $10.15 a share, giving us a fair value of $247.01, which is a whopping 122% upside from the current price. And the last model that we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this are the dividend yield and the PE ratio. In this case, we've imported the dividend yield of the past 5 years, and on average, it has been sitting at 3.11%, and the current yield is 5.44%, indicating that it's currently undervalued on this metric. The PE ratio of the past 5 years has been sitting at 18.69%, and the current PE ratio is sitting at 10.96, meaning that it's also undervalued in this metric. Then we get a fair value of $192.25, which is almost a 73% upside from the current price. If you want access to all of the models that I use in my videos, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at the final overview of our valuation next. Looking at our final overview, we've imported the discounted cash flow, the discounted dividend, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, and we've got an average out of these of $143.15. Our margin of safety we've determined earlier using a standard margin of safety of 25%, adding 5% for the EBIT growth, 5% for the margin growth, and deducting it by 5% for the dividend growth, leaving us with a margin of safety of 30%. Applying this margin of safety, we get a fair value of $100.21, and with the current price of $111.26, we get a downside of almost 10%. So in this case, it's indicating a sell. Keep in mind that without the margin of safety, the fair value would sit a lot higher, but also keep in mind that there's still lawsuits going on and there's still a lot of uncertainty. If you like this video, hit the thumbs up button, and if there's any other companies that you would like to see me cover on this channel, please let me know in the comments. Thanks for watching.